Hello! Today we are going to be discussing the bank reconciliation. Before we explore a problem, I want to discuss what the purpose of a bank reconciliation is. A company that has a checking account with a bank usually keeps track of the account's transactions in their accounting records. The bank will also have a record of the company's transactions related to the account. So that's two sets of records, one from the company and one from the bank. But there are often differences between the bank's records and the company's records, typically due to timing differences. So we might see one transaction in the accounting records that's missing from the bank's records, or vice versa. Whenever we find a missing transaction, we need to record an adjustment on the bank reconciliation to update the relevant account. For example, the bank may have charged a fee to the company that the company does not yet know of, as of the end of the month. This is a fee that appears on the bank statement, but is missing from the accounting records. Since the accounting records do not reflect this fee, we need to add a line to the bank reconciliation to correct for the missing fee. So a key thing to keep in mind when completing the bank reconciliation is who has recorded the transaction and who hasn't. Wherever the transaction is missing, either on the bank or the book side, is where an adjustment needs to be made. Okay, so here we have a problem related to Barney's Rubble Removal Service. The problem says, on May 31st, 2011, Barney's Rubble Removal Service had a book balance of cash of $9,946. The May 31st, 2011 bank statement showed a bank balance of $11,150. Additional relevant information concerning the company's checking account follows. But before we go on to the additional information, let's copy down the bank and book statement balances. We have a bank statement balance of $11,150 and a book balance of $9,946. So here we see the discrepancy between the two balances, which we will now correct using the additional information. The first piece of information says, the April 30 bank reconciliation showed that check 101 for $527 and check 102 for $802 were outstanding. Check 102 is listed on the May 31, 2011 bank statement along with the other canceled checks, but check 101 is not listed. So there are two terms here that you might not be familiar with. The first one is an outstanding check, which is the check that was written by the company that has not been cashed. So the company has written a check as a payment for something, but the party receiving the check has not made it to the bank yet to get his cash. Since the check has not been cashed, it will not appear on the bank statement. So this is missing information on the bank statement. Since checks act as payments, this is a missing payment for the company, or a deduction from cash on the bank statement. So whenever we have an outstanding check, we must deduct from the bank balance. The other important term here is a canceled check, which is also a check that's been written by the company, but this one has been cashed. Since the check has been cashed, it will show up on the bank statement, and since the company wrote the check, it will show up on the accounting records. So there's no missing information. Both the bank and the company will have recorded canceled checks, so there's no adjustment needed for them. Now that we have the definitions out of the way, we notice that in last month's bank reconciliation, in April, there were two outstanding checks, 101 and 102, meaning they were written but not yet cashed. In this month, which is May, we know 102 is now canceled, meaning no adjustment is required. But 101 is still missing from the bank statement, meaning it's outstanding. So we need to deduct $527 from the bank side for check 101 to correct for the missing information. Next, we are told that check number 104 for $107 and check 110 for $39 were both written in May 2011, but they are not listed on the bank statement. Again, these are checks the company has written but are not showing up on the bank statement, which classifies them as outstanding checks, meaning we need to deduct them from the bank balance. Next, we have a deposit of $290 that was made on May 30 that is not listed on the bank statement. The giveaway here is that the transaction is not listed on the bank statement. If something is not listed on the bank statement, that means the bank statement is missing something and we need to make an adjustment to correct the balance. In this case, the deposit adds to the cash balance, so we need to add $290 to the bank statement for the deposit. The next transaction states that the bank statement reveals that a check received from a customer for $129 was NSF. The bank also charged the company a $25 NSF fee. NSF stands for non-sufficient funds. It means whoever wrote the company this check did not have enough cash in their account to pay the company. In short, the company doesn't have the $129 that they thought they had, and now they have to pay a $25 fee. The missing information here is more incorrect information, as the company's records would show receipt of the $129. Since the check was NSF, the company doesn't actually have the cash, so the adjustment needs to be a deduction from the book balance. Usually we pair the fee and the check together in one line on the bank reconciliation. So that's 129 plus 25 equals $154 deduction from the book side. So we list that as NSF check plus $25 fee for $154. Next, the bank statement reveals that the bank collected a note and related interest on the company's behalf during the month. The principal of the note was $1,000 and the interest was $100. The bank also deducted a $20 fee for providing this service. So we have some cash that the bank collected on the company's behalf. This is information that the bank is providing that's missing from our accounting records, so we need an addition to the book balance. The way we title this is Note Received plus $100 interest less the $20 fee. The note was worth $1,000 plus $100 minus 20 gives us $1,080 in cash received. We don't separately list the fee and the interest here, as we would prefer to list the total amount cash changed by, which is $1,080 in this case. Some teachers may have you list the interest separately, so make sure you follow the conventions used in your class. Next, the bank statement reveals the bank charged the service fee of $15 for the month. The fee was charged by the bank, so the bank already has this transaction recorded. But until the company makes an adjustment, the $15 will be missing from the accounting records. Therefore, the adjustment is going to have to be on the book side to deduct the $15 fee. Finally, in comparing the bank statement against the checks written during May, a discrepancy is discovered concerning check 112 for telephone expense. The bank statement correctly lists the check at $210, while the accounting record shows $120. So here we have an error, which can be one of the trickier lines on the bank reconciliation. I suggest you approach errors in a three-step process. First, determine who made the error. In this case, we are told the bank correctly listed the check, so the error is on the book side, which is where we will need to make the adjustment. Second, determine how much the error is for. The correct amount for telephone expense is $210, but the company recorded the amount as $120. So if we subtract the two numbers, we get a $90 error. Third, determine whether or not the amount found in step 2 needs to be added or deducted on the bank reconciliation. Since the relevant account here is telephone expense, we know this was a cash payment for $210, but our records only list the expense as $120. So we only deducted $120 when we should have deducted $210. In other words, the company deducted $90 less than they should have. So the adjustment needs to be a deduction of $90 for the book side to get up to the $210 total. Okay, now that we have gone through all the transactions, we can total everything up and find the adjusted book and bank balances. So usually what we do is you can do an underline next to each of the totals. So I'll do a bottom border here. Since there's only one addition here, we can just copy that number over here on the right. We can add up these three outstanding checks. So I'm going to use the sum function, and that gets us $673. And then we only have one number over here, so we can just copy that to the right-hand column. We have three numbers over here, so we can total those up. And then to find your balance, you take the original amount, so starting on the bank side, 11,150. We add the deposits in transit, and then we subtract all of these deductions, the outstanding checks, and get a balance of $10,767. Now hopefully we match that when we do the addition over here. So we have 9,946 plus 1,080 minus 259 gives us 10,767. Now it's time to do the journal entries for the book balance. We can ignore the bank statement adjustments as far as journal entries go, since we are completing this problem from the perspective of the company. We only need to look at the book side. Each line on the book side will be a journal entry, and the number listed will be applied to cash. For the add transactions, we'll need a debit to cash, and for the deduct transaction, we'll need a credit to cash. These entries are adjusting entries, so they'll all be done as of the end of the period, in this case, May 31st. So I'll get out my journal paper that I've been hiding here, and you'll see I have May 31st as our date for the 4 different transactions we have. So there's 1, 2, 3, 4 journal entries we're going to have to record here. So first we have the note that was collected. As I just stated, the number listed of $1,080 will be the debit to cash. So we can put that down. There was a $20 fee, which is an expense to the company. And we usually call this collection fee expense, which is for $20. Now there was also $100 in interest earned, so we're going to use interest revenue for that, and we will credit interest revenue for $100. And then to balance this whole thing out, we still need another $1,000, and that ends up coming from notes receivable. We credit notes receivable here to remove the account from our records, since now it's been paid. Next we have a deduction for the NSF check. Now there was a $25 fee involved here, but typically what the company will do is pass on that fee to whoever sent them the bad check. So the company will be asking for the total of $154 back from whoever sent the NSF check. So we record that as an accounts receivable. And that just represents they owe us $154. Remember, we are in the deduct section, which means we will have to have a credit to cash, and that's also going to be in the amount of $154. Next, we have a service fee of $15. Since the amount is typically small, we classify the service fee as a miscellaneous expense. And remember, since we are in the deduct section, that's going to be a credit to cash again. Finally, we have the error of $90. If we look back at the problem, we remember that this was for the telephone expense. So that's the account that needs to be adjusted. And that's for $90. And again, since we are in the deduct section, that's going to be for cash, and that's also $90. Alright, that concludes our video about bank reconciliations, including our journal entries.